This will not be a video about making a lot of money. If that made you click away, good. This will be a video about how to protect your wealth. I will reveal to you what the so-called, by me, insurance assets are, why they are important, and why they can literally save your life. I mean, your actual life, not your investments. But first, let's broaden out a bit. I have a big issue with how financial advisors and gurus define risk. When you hear them talk about it, it is always related to losing 50% of your stock portfolio, or volatility in the stock market, or mixing bonds with stocks so that you don't have big losses during recessions, and on and on and on and on. And I'm like, do you people even understand what the full meaning of risk is? So let's dive into the topic. The financial industry's definition of risk often is extremely limited because it only looks at risks within the financial markets. It makes sense because that's where these people spend their whole day, but it's very narrow. An example of a risk within the financial market is you having a stock that goes to zero, or losing 30% of your portfolio because of a market downturn, and other examples like that. Now, you certainly need to know about these things, and we will discuss them later in the videos from the series. But first, I want to explain to you that risk is not confined to a stock going to zero or your portfolio losing 30%. You know what else risk is? War. Having to flee your country. Confiscation of private property. Totalitarian governments. Hyperinflation. And other cheerful events like these. Now, depending on where you're watching this from, some of these might sound a bit far-fetched, but to some of you, these risks might be very real. To the latter crowd, you already understand the importance of what I'm talking about. To the former crowd, don't think you're beyond the reach of these events. Of course, if you live in the middle of USA, you might not be as concerned about a foreign invasion or hyperinflation, but that only means that you might want to allocate some more percentage of your portfolio to these insurance assets, not eliminate them entirely. Okay, so what assets am I talking about? There are two main types in this category. The first one is precious metals, and the second, cryptocurrency, mainly Bitcoin. These are the type of assets I will talk about next. Now, before we go into the details of each one and why you want to own it, let me explain to you why I have chosen to teach you about these two types of assets and call them insurance assets. At first glance, there is little in common between precious metals and cryptocurrency. One asset type is a physical object and the other is digital. One is probably the oldest asset type that exists with thousands of years of history, and the other is the newest with roughly 15. One is associated with older folks who are extremely financially conservative, and the other with younger millennials and Gen Z. One is the ultimate place where you store your wealth, and the other is the ultimate gambling vehicle. With so many differences, you might be thinking to yourself, why is that guy putting them in one bucket? Is he insane? Well, if you ask my family members, they might tell you I am, but that's a topic not related to the current video. While I understand the vast differences I just pointed out, when it comes to protecting yourself from extreme and adverse events, these two asset types have a lot in common. The main thing is that they are both what's called bearer assets. Bearer, not bear. A bearer asset is an asset that doesn't require a third party to be present when a transaction occurs. There are only three types of assets like that: cash, precious metals, and cryptocurrencies. The common thing between them is that you can transact with another person without the need of a third party. For example, if you want to buy food with your Visa credit card, Visa can stop or spy on the transaction. If you want to transfer money to an individual that your bank doesn't want you to transfer money to, they can easily stop the wire. If you want to sell or transfer your shares in Apple, your brokerage, where you hold the shares, or even the stock exchange, can ban you from doing it. And even with something tangible and physical like real estate, you can't transfer property rights unless a centralized property register acknowledges the transaction. I mean, you can kind of trick someone into giving you money for your house, but unless they're a complete fool, they will want some documents and a third party like a notary service confirming their ownership. However, if you want to buy food in the store, you can pay with cash and no one can stop you or even know you did it. If you meet someone in the middle of the forest and give them gold coin in exchange for a forbidden secret book, no one can stop you. Same goes for sending Bitcoin to anyone in the world. So that's the most important characteristic of the bearer assets. The second thing in common between cash, precious metals, and cryptocurrencies is what is known as self-custody. In simple terms, self-custody means you don't rely on any third-party service for access to your assets. To illustrate the point again, let's go through the main other asset types. If you have money in the bank, you need the bank's permission to have access to it. If you have stocks, the brokerages is holding them on your behalf. This is not necessarily a bad thing, I'm just describing facts. If you have real estate, you need the acknowledgement of the state in some form of register in order to own it. Otherwise, you would have to patrol your properties with a gun to make sure they are still yours, which is obviously ridiculous. Cash, precious metals like gold or silver, and cryptocurrencies are the only three assets you can store by yourself without the permission or knowledge of anyone else. Unless you are physically forced to give them up, they cannot be confiscated with the stroke of a pen of a bureaucrat. Okay, so we have bearer assets and self-custody in common between cash, precious metals, and crypto. The third thing I will talk about is where physical cash drops out from what I call insurance assets, and the reason I am not including it. And that is control by a centralized body. You see, even though you can hold cash in your pocket, its value is still controlled by a centralized body called the central bank. Yes, you can move it freely without the approval of a third party, but its value is not subject to only the market forces. Your cash can literally become worthless overnight with a decision made by a few people in a building situated at the other side of the country. This is impossible with gold or Bitcoin, for example. Now, if you're watching this from the USA or Canada or Europe or any of the more advanced stable nations, then this might be less of a concern. But anyone watching me from a country like Egypt, Turkey, Argentina, Nigeria, and others are painfully aware of what I'm talking about. Some of these people have lost all the value of their savings with the stroke of a pen of a politician. And even if you live in the USA or Europe or Australia, well, over the past century, even the strongest currencies like the Swiss franc and US dollar lost over 95% of their value. Whereas if you had an ounce of gold a century ago, you could buy a top-notch outfit and you can still buy one today. Also, we are not only talking about inflation and hyperinflation. Governments can literally decree that certain type of euro or dollar bill is not accepted anymore, and all of that cash under your mattress become worthless. So, why the term insurance assets? Because in my opinion, while you can make money trading these, their main goal is not to make you rich. Their main goal is to protect you. And yeah, I know, you can buy Bitcoin for 10K and sell it for 50K, but that's more on the trading side and not what I want to focus on. Those types of assets are insurance assets because they protect you from extreme unforeseen events and allow you to have complete control over them. Unlike the productive assets, which I described in the previous video and will talk about later in the series, which generate economic value and so can pay you for owning them, a gold coin buried in your backyard does nothing. A Bitcoin sitting on the blockchain does nothing. They don't produce anything. This is the main reason why I would never advise anyone to make them the majority part of their portfolio. However, depending on where you live and what your personal situation and beliefs about the world are, I think it's healthy to have those types of assets as a minority part of a diversified portfolio. Now, as I said, these assets won't make you live noticeably better. They don't produce anything, they won't pay your bill or allow you to retire. However, what they do is insure you, hence the name, against black swan events. For those of you who don't know, black swan event is something extraordinary that no one can foresee happening, like COVID, 9/11, war, a government making a decision in the middle of the night, etc. Your stock portfolio falling with 20% is not extraordinary, and I'm not talking about these kinds of events. An invasion or a civil war starting in your country or an overnight currency hyperinflation is what these assets are made to insure you against. So, now that you have the overall picture and knowledge, in the next part I will focus on the two types of assets in this category: precious metals and cryptocurrencies, starting with precious metals. What is the purpose of precious metals as an investment, and should you have them in your portfolio? Precious metals are the typical and oldest example of an asset that doesn't need a trusted third party and which you can hold and transact with yourself. They are a so-called bearer asset, which means you can literally carry them in your pocket, meet a stranger on the street, give it to them, and receive something in return without the need of a bank, credit card company, or any other institution. Now, that also applies to precious stones, but I doubt I have a lot of people watching that would invest in diamonds or emeralds, so for the purpose of this video, I will keep the conversation to the main precious metals, which could be used both as money and investments. And those are gold and silver. Of course, other types of metals have been used as money as well, like copper, but this is hardly something you can invest in, so I will keep it aside for now. Precious metals have been used as money for thousands of years across different civilizations that had no contact with each other and across all continents. The most obvious example is gold. Gold has always been valued because of its scarcity, natural beauty, and its indestructible nature. The yellow metal does not corrode, it can be melted and reshaped easily without losing its quality, and it does not rust. There are literally golden coins and jewelry found in graves from thousands of years, and if you simply wash and polish them a bit, they are as good as they once were. Because of that, throughout human history, all countries have used gold as a store of value and medium of exchange. Basically, gold was money right up until the 20th century, when the current monetary system was invented. The short version of why that happened is the following. Gold, being a physical object, is really easy to steal and dangerous to move around in large quantities. Hence, as trade grew and became more complex, more and more people started storing it in centralized vaults and trading paper notes instead. Imagine it like this. If both you and I know there is 1 ounce of gold in bank X and you have the ownership of it, which can be proven with a note from the bank, then I can accept that note instead of the gold as a form of payment. To the bank, it doesn't really matter whether you or I will redeem it, and to you, it doesn't really matter whether you pay me with the note or the gold itself, because either way, you part with your gold and receive what you want. Fast forward a bit, and gold started to get centralized. At one point, the banks found out that not everyone is going to suddenly redeem all the gold at once, so they started lending more gold than they actually had, using these receipts in order to make extra profit. As a result, the majority of the world's gold ended up sitting in centralized vaults, and people were using paper notes as money instead. Later on, in the 20th century, for reasons that are too long for me to explain here, the governments decided that they won't back the whole circulation of currency with gold, but only a part of it. And in 1971, the link between the US dollar and, as a consequence, all other currencies and gold was broken, and we entered the era of the so-called fiat money, which are created entirely by governments. From that moment on, gold became purely an investment asset and was no longer money, and the same applies to silver. This is the very brief and oversimplified story of how we got where we are today. As a result of that, you can no longer get a gold or silver coin and go to your local store to buy milk, but the usefulness of these precious metals as a store of value still remains. So, why are they still useful if they are not used as money? There are 2 main reasons for that, which we'll explore now. The first reason is that ever since paper money was divorced from gold, its value has been dropping or outright disappearing over time. The average currency has lost almost all of its purchasing power in the last century, and even the US dollar or the Swiss franc have lost 95% of their value. However, you could still roughly buy the same amount of oil or clothing with an ounce of gold today as you could a century ago, which means that gold preserves the purchasing power of its holders in the face of currency depreciation or even outright hyperinflation. However, if this is your only concern, there are far better assets to own which are economically productive, can grow more than gold or silver, and can give you cash to live with. We'll talk more about them later in the series. The second and main reason why precious metals are useful is the main reason they're in the insurance category of assets. The fact that you can self-custody them, meaning that you don't rely on a bank, centralized register, or a credit card institution. If you own a piece of land in a country with corrupt government, the people in power can simply change the name of the owner of the land in the register and you no longer own it. But if you own gold coins and go to literally any small town in the world, you will find someone to sell them to without asking for anyone's permission. So basically the asset is permissionless and also preserves your anonymity. You can own gold without anyone knowing it. As a result, depending on where you live, if you fear a collapse of the financial system or an authoritarian government confiscating your assets, you can protect your wealth by owning precious metals yourself. A very important note here is that the second benefit of gold or silver, the self-custody element, is only valid if you, well, self-custody it. If you own a gold fund on the stock market, for example, you might get the benefit of protection of your purchasing power, but you are reliant on a third party to honor their promise to you and give you that asset when you need it. Same applies for storing your gold in a vault. For these reasons, I find it strange that people choose these strategies, and I'm advising you to never do either of these. If your government decides to confiscate assets, or more specifically gold, where do you think they will go first? To all the banks and vaults that hold it. You might as well invest in stocks or real estate which at least produce something and give you rent or dividends. And if you think this won't happen in your country, Check Executive Order 6102 from 1933, by which the United States government forced all citizens under threat of 10-year imprisonment to surrender their gold to the government. With that order, they kept owning gold illegal for 40 years. If that can happen in the USA, trust me, it can happen anywhere. Similar laws have been enacted in the UK, Poland, Australia, and other places. The reason for the confiscation was that at the time the dollar was backed by gold at 40%, and so during the Great Depression, the Federal Reserve, the central bank of the USA, could not print more money to fight the depression because it had no more gold to back it. By buying up people's gold at way lower than the market price, the government basically removed the constraint and the Federal Reserve could print more money. Anytime the government sees private ownership of gold as a threat, they won't hesitate to take it from you. Because of that, I believe that it is foolish to own precious metals in any other way than by holding them yourself. However, that introduces the big problem I mentioned in the beginning of my brief history lesson: theft. If you simply hold it in your house, it's easy to be stolen, which is exactly why I personally don't own any precious metals. They can be easily stolen in my home, and holding them in a centralized vault seems stupid to me. But if you can find a clever way to do it, I believe a small allocation to gold or silver, around, let's say, 5% of your portfolio, would be reasonable. Now, with all that said, in the past 15 years, a digital cousin of precious metals has emerged whose goal is to fix the problem of theft and physical confiscation. And that cousin is called cryptocurrency, which is what we will talk about next. What is cryptocurrency and does it have a place in your portfolio? This is probably the most controversial asset of all. Some people are literally ready to die for it and have dedicated their whole life to crypto, while others shrug it off as magic internet money and are even saying only criminals would use it. What is the truth and how does it concern you and your investments? This is what we will talk about here. Before we dive in, I first need to explain two major points. The first one is that in this video I will only be looking at the fundamental qualities of crypto and the reason why I put it in the category of the so-called, by me, insurance assets. And the second one is that I will be focusing on things like store of value, decentralization, censorship resistance, etc., and will mainly reference Bitcoin and perhaps a little bit of Ethereum. I will not be discussing the 1,000 different crypto projects and coins aimed at solving a specific problem, like digital file storage, supply chain management, etc. So, with that said, what is cryptocurrency? The brief version is that in 2008, Satoshi Nakamoto put together a number of existing technologies, with his own innovations added to the mix, to create the concept of digital scarcity. There were a number of predecessors that solved parts of the problem, but this was the first one that put enough pieces together to become a big success. Who is Satoshi? No one knows. Perhaps he is not one person, perhaps it's a group of scientists, or perhaps it's a joint project between fractions of the NSA or CIA. Honestly, there are thousands of theories, but that's not what is important. The important thing to focus on is that a technology was invented that for the first time allowed public, digital, immutable, decentralized storage of information. This is what is known as the blockchain. Blockchain is like a shared public record of transactions stored across many computers. Each transaction is added as a block linked to the previous ones, creating an unchangeable chain that's secure and transparent for everyone involved. And because of that, for the first time, a form of money could exist that is digital and did not rely on a bank, credit card institution, or a central bank in order to be stored and exchanged online. That's how Bitcoin was born. Now, you might be thinking, but wait, crypto is what teenagers use to get rich. Why are you classifying it as an insurance asset? Well, after explaining what the blockchain is, we can now go to explaining the main qualities of Bitcoin that make it part of my insurance asset category. The first one is that it's a bearer asset, which you should know from previous explanations means that there is no counterparty risk. You hold it, you have it, and you can do whatever you want with it. You don't need the approval of a bank, credit card company, or a brokerage to move it around. Because of that, it is also censorship resistant. That means that you can literally send money to anyone in the world, in any country, and there isn't an authority that can stop you. A third very important quality is that, just like gold, when governments print money and devalue paper currency, the value of crypto goes up. It goes up by different amounts, of course, and in the past decade and a half, Bitcoin has wildly outperformed gold, but the idea is that it's a protection against inflation, money printing, and hyperinflation in general. Talking about gold, Bitcoin has been named digital gold because of the similarities it has with the yellow metal and its uses as a bearer asset that has no counterparty risk and is censorship resistant. However, There are three key differences I want to talk about, which you have to understand in order to comprehend Bitcoin and crypto in general. Two of these differences are Bitcoin's advantages, and one is a disadvantage. First, the disadvantage. Although crypto is pretty anonymous, as I said, the blockchain is a public ledger that anyone can open and check. Tracking transactions and addresses is hard, and especially certain types of crypto wallets, which we will talk about later, are not connected to ID documents. However, there have been cases where government agencies use private companies specializing in analyzing the blockchain and have been able to track down criminals. Now, this by itself is good, obviously, but it also means that there isn't the level of anonymity you have when you are giving a gold coin to someone in the forest. Whether that concerns you or not depends on where you live and what you want out of your cryptocurrency. Let's start with the advantages of crypto compared to gold. The first one is that if a person holds their crypto properly, they literally need to be tortured in order to have it stolen from them. This is a significant improvement compared to gold, where a thief can break into your house while you're not there and take your gold from you. With cryptocurrency, you can hold it on what is known as a private cold wallet, and it can only be accessed by the person having the so-called keys to it. This can be a special device which is encrypted with a code or even memorized phrases. If you hold it that way, A, no one will even know you have it, and B, even if you have your device stolen, since it's encrypted, the thief can't do anything with it. Here a lot of people get mistaken that the cryptocurrency lives on the device, and so if it's damaged or stolen, you lose your funds. But that's not the case. All cryptocurrency lives on the blockchain, which is a public network secured by what are known as miners. These miners solve algorithms and spend real-world energy to secure the network and mine new blocks from the blockchain and are rewarded for it. In that situation, your key is only a way to access your assets which are on the blockchain. But these assets don't live on your device or whatever else you use. Just like I have discussed previously with gold and centralized votes, if you plan on holding crypto, please don't hold it on centralized exchanges. This completely defeats the purpose of it. There is a saying in the community that goes like that: not your keys, not your crypto. This is the first ever digital asset which you can store and secure yourself. Take advantage of it. The second huge advantage crypto has over gold is that it's immensely easier to transfer. It's native to the internet, and so as long as you have internet connection, you can transfer value anywhere on Earth without intermediaries or a physical package traveling. This, combined with the previous first advantage, removes the biggest two drawbacks of gold, which forced it to get centralized over time. Unlike gold, Bitcoin is very easy to move and at the same time very hard to confiscate. For the first time in history, you can literally move through customs, airports, and even totalitarian governments' checkpoints and carry your wealth in your head. Then get to a more peaceful and democratic place, find a laptop, and make use of it. This is completely revolutionary. Now, a lot of people hear those qualities and immediately think it's a tool for criminals, but I'm extremely opposed to that view. You see, I'm a person who likes eating food and also likes camping in the mountains. When I engage in both activities, I use knives that help me. The same knives can also be used by me to hurt people. Do you want to live in a society that forbids knives? And are knives to blame? The argument that Bitcoin can be used for criminal activity is just as stupid as banning kitchen knives or banning physical cash. To illustrate what I mean, I only need to tell you a few of the thousands of stories of people escaping corrupt governments or war zones, having everything they worked their entire lives for taken away from them, but getting to safety with Bitcoin and being able to start a new life with it. The stories are too many to count, but for example, I read about this woman from Syria that literally had everything stolen from her on her way to Germany. I mean, even her wallet. When she got there, however, she was able to connect to the internet, cash out her Bitcoin for euros, and at least pay for rent, food, and new clothes and start her life in Germany. Or the Reddit post I read after the war in Ukraine started, of the person who escaped the war, left his real estate, which was destroyed, had his debit cards, but the bank was not functioning, and literally the only thing he had was his crypto wallet. There are also countless stories of people running from hyperinflation or totalitarian governments in Venezuela or Argentina, or war-torn places like Afghanistan, or from political oppression in Iran. Bitcoin and crypto are not tools for criminals. They are tools for freedom. How you use them is up to you. Just like with knives or with cars. You can use your car to get your pregnant wife to the hospital, or you can use it to run over people while you're drunk. The decision is yours. It's not the car to blame, and I think we agree we definitely should not ban cars. Now, unlike the so-called Bitcoin maximalists, I am a rational thinking person, and I need you to know that by no means is crypto the be-all end-all of all assets and is indestructible. A very fun mental exercise I like to do when I talk to these people is to ask them the following question. What if all the developed world governments collectively decided to make it illegal? What then? Cryptomaniacs often like to focus on the technology and how the cryptocurrency cannot be confiscated. Fine, it's true. But they often lack historical, practical, and political understanding of the world. Bitcoin is great for protecting you against a single authoritarian state or a war-torn country. It excels as an asset class in helping you get out of there with your wealth. However, what if all governments decide to collectively make the use, sale, or storage of cryptocurrency a crime? What then? And to this question, I have never been able to receive a proper answer. Let's say you have 10,000 Bitcoins on the blockchain, but you cannot exchange them for money and you can't buy a loaf of bread with them. So, you have random digits on the blockchain with no ability to even pay your rent. If you think about it, there's no normal country in the world where you can take an illegal drug and go to an official exchange to turn it into currency. If the status of crypto becomes the same, it's game over. Another disadvantage of Bitcoin is that it doesn't produce anything. Just like gold that is buried in your backyard, it just sits there and does nothing. Now, there are other crypto projects like Ethereum and others which have a kind of economic utility within their own network, but that's a separate talk for a separate video. So, with everything I just said here, what is my attitude and advice when it comes to cryptocurrency? I view it as the best asset in the world to protect yourself from unforeseen events like wars, political oppression, confiscation of private property, and others, if it is held properly. Because of that, I think it has a place in everyone's portfolio, but as part of the insurance bucket, not the get-rich-quick bucket. However, making it 80 or 100% of your portfolio is, in my opinion, stupid for the reasons I already outlined. With that, we conclude the insurance part of the portfolio from our Investing for Beginners guide. In the next video, we'll start talking about how to invest in productive assets that produce cash to pay for the life of your dreams. So click on the video that should have appeared on your screen already, and I will see you there.